I welcome you all for this workshop on designing factor investing strategies. We have Kshitiz Jain with us. Kshitiz Jain is a member and volunteer of CFA Society India. Kshitiz has been spearheading the direct equity verticals at CAGR Wealth, wherein he has been managing active investing strategies. Kshitiz has been a key driver in setting up the research and decision-making process at the firm. Prior to joining CAGR Wealth, he was working as senior associate treasury at CTBC Bank India, where he was responsible managing the firm's bank's investment. BTech degree from IIT Roorkee and has an MBA from IIM Bangalore. He is a CFA charter holder and a financial risk manager. Over to you, Kshitiz.
Thank you, Vijay. I hope everyone is able to hear me. Is my voice audible at the back? Yeah, okay. So thank you, Vijay. Thank you, CFA Society India, for this opportunity to interact with fellow members and interested participants. Uh, uh, so, see, the idea of today's workshop is the topic was very broad, designing quantitative investing strategy. So I think that is a very broad topic, as you would have probably, if you would have attended the Mr. Suri's session, the it is a very broad topic in quantitative investing. I'm actually looking at only a very small subset, which is factor investing. It goes much beyond this. So, and also this is, if this is more of an introductory session, I see many investing wizards and here and experienced investors who have already dealt with, may have dealt with all these investing strategies, but so bear with me. This is more of an investing introductory session. Sorry. Yeah, this is more of an introductory session. Then finally, which is the main topic of the day, is that how do we design and backtest factor investing strategies. We will try to take up simpler one or two simpler strategies to see how we can actually design it, and then participant can build on it. Finally, one thing which I would normally like to cover is how do, once we have designed a strategy, how do we live track it as a how do we track the performance of that strategy live, right, without actually putting in money, but doing it in a simple but a very professional manner. How do we actually live track a strategy, right? So let's just begin with the uh, first thing. In general, for factor investing, for a long time people have been trying to answer this question, that what is this, what explains the difference between the returns in a basket of stocks, right? If you take 125 basket of stocks and another 25 basket of stocks, there will be differential in returns and risk, right? What is what defines this differential, right? If you can answer that, probably we will be able to harness that. So that has been driving a lot of research over the years in investing. And any fact, so factors are nothing but the term which tries to explain this characteristics of a group of securities, which defines its risk and returns. But there can be thousands of factors, but not all factors are investable, right? So for a factor to be considered investment factor, the one important thing is that it should be investable. First of all, it should not be something which you cannot invest, or if you invest it goes away. So it should be investable. It should be persistent. By persistent, you mean we mean is that it should be persistent across geographies, and also it should be persistent over time periods, right? So it should not be that it worked in one in one decade and didn't work in other rest of the period. So then it will not be considered an investment factor. It will be a factor to explain the returns in that decade, but it's not an investment factor. Obviously, it should be one thing which is very important. It should be intuitive, right? We should be able to pinpoint and what is the reason this factor is actually generating higher returns. Either it can be a behavioral reason, or it can be actually a higher risk being taken by market participants by utilizing that factor. So that is what we need to do. Now, uh, we just saw a lot of there are 5 or 6 factors which are very very common in the investing world, right? The most common of them, value, size, which is nothing but small cap or mid cap investing as compared to the large cap multi market cap factor. Then there is momentum, then there is low volatility, then dividend yield, and quality and growth. So if anybody, if you want to take a go, if one of these factors, if you want to explain, and how will you capture it, if somebody can uh, come in, and I yeah, if somebody wants to try, what is, for example, value? How do you capture it, and what is the definition of a value factor? Okay, that's how you capture it. What is value factor? Yeah, so value factor is nothing but you try to get a group of stocks which are considered cheaper than their inherent value, right? So that is what you are trying to harness, and this is, I think, being made famous by the investing greats of our times, like the Buffetts and the Charlie Munger, and even there are many others. The value investing is the most has the most cult following in our era. A lot of them have transitioned from a value investor to a quality investor. That's a separate thing, but all of them started with Graham's model of trying to find value and margin of safety. So that's where value investing comes in. You try to capture it, like you said, price to equity, price to book, even EV by EBITDA, market cap to sales. There are a lot of variables you can try to capture and model, right? Anybody else wants to take a go? Otherwise, we'll probably I'll just show what is the definitions, and any quality dividend yield anybody wants to explain. No, so fine. Let's not. Uh, so yeah, so let's just try. Let me try to explain. I'll not go with each of them. Uh, so low volatility for that example. So basically, like Pim said, you are trying to capture returns, and low volatility is the most unique. Like we had last session, the whole factor universe is built on the fact that, or the first attempt to actually try and find a factor was KEPM, right? That was a single factor model where you said, okay, every market differential between two stocks can be explained through its beta. So if you take if a stock has higher beta, it will have higher returns. So that was our explanation to or a single factor model. Then the next attempt to factor investing was Eugene and Pharma French with their 3 factor model, where they said market factor, value, and size, and they tried to explain the returns. And they, in their research, which was also not completely which was good at that time, but not fully correct, was that they said market factor only explained 67% of the returns differential between two stocks. So there is still that 33%, and I think over a period it kept on. There were other factors found, and we were able to actually attribute a lot of the differential to different factors. Now, so now asset managers and even risk managers, for that matter, and even asset owners, are now utilizing these factors to not only understand why certain group of stocks are giving extra returns, but they are also, once you have understood that, they are also utilizing it to generate those high returns, right? So that's where factor investing comes in. We've understood what factors are, why certain quality companies, if you take a group of stocks of quality companies, will generate high returns. But the idea is, once you have understood those factors by using data, you can generate higher returns. So that's where factor investing comes in. Why it has become popular? There's this one simple reason. It has higher risk adjusted returns, and it has been it has though the factors have given across globe. Some factors may not have worked in one or two countries, but normally factors have generated higher returns across the globe. This is a beautiful chart for MSCI world where, which is pointed out, is the market cap index of the world equity, the data from December 1999 to December 2022. You can see where PIM is coming from. The minimum volatility is actually generated higher return with a much lower risk, right? And quality has also done well. All of them have generated higher returns. With some of them, like value, for example, has even higher, had taken higher risk, but has commensurately generated higher returns. So this is the reason for the popularity. But one important thing is, see, something can generate higher returns, but we need to to actually implement it. We need to have an understanding why something is working, right? So in factors, normally there are two types of explanation. One is systematic. Either you are taking systematic risk, which is diversifiable, or you're utilizing behavioral patterns, right? So for example, in value, what is considered in value and size both, right? There is research to say that the value stocks or the low P stocks or smaller cap companies are more prone to disruptions or more prone to risk in macroeconomic shocks, right? So there is a study say that actually the premium earned by value and size are actually due to the higher risk taken by those participants. So, right, you are actually being paid off for taking higher risk. The other explanation to the same thing in value is that normally people, once a sector has undergone underperformance for a long time and it starts performing, people are not able to realize it that quickly or are able to re-rate it that quickly. For example, if you, let's say, PSU stocks for that example. So PSU stocks for a long time, I think, as far as when I started, it's been a journey where they've underperformed quite meaningfully. Many of them were low P stocks and specifically had value. So not necessarily all low P will be considered value, but they had value because were doing similar amount of business, but due to any management quality, we can say probably they were low P. But once they started improving, the market was slow to realize that, and that's where the alpha comes in value, right? Market is normally slow to realize once the re-rating comes in. So, and similarly, why momentum works is same. Once something starts performing, market is slow to re-rate it downwards also. So the once something gains momentum, it will continue to perform well. So that's the simple reaction. And also any good data, if you would see, probably if you go back and see, once any good report comes in, or good numbers come in, there is slight bit of underreaction if a major change has come in. For example, if you, let's say, there is a small condom company where the promoters have changed, and the company has been underperforming for a while, last 2-3 years, for the same reason, because the promoters were looking to exit. Now the promoters have changed, suddenly there is a re-rating, but that news came in a while back, right? So that's where the markets undergo, for good news there is underreaction, for bad news there is overreaction. So these are the cycles where momentum actually works. Now, moving on, let's just see how the factor strategies are performed in India, right? This is the last decade from September 2023, 13 to 2000, September 2023. From, I think the chart is somewhere ending. So most of them have performed better than the Sensex or the large cap index. Specifically, the ones which are doing very, very well are the size, momentum, even low volatility, quality, all of them has done well. So, obviously, if you see size, that has the biggest, most largest volatility. It goes into those cycles of boom and bust considerably, but it has recently done well. And there are some macroeconomic reasons for some factors do well in certain macroeconomic situations. So that is the reason uh, they did well. Value, if you see, had a terrible last few years, and post COVID, we are seeing the rise of value investing again, or the value factor. Value investing, I think, is a much more abused term, the value factor has come back. You are seeing stocks doing well. Yeah, so that's the thing with factors, right? I'll probably will say so like Ravi is saying, factors, if it was so easy and they are going to generate alpha, everybody would be doing that. So the reason they actually perform is the reason is they are actually very very cyclical, right? So if we see, just we have used S&P BSE indices in India. If you see the top number, the best performing factor actually keeps on changing. For only for 2 years, we have like 2020-21, we had the size factor doing well for 2 continuous years. Otherwise, the best performing factor actually keeps changing. Many times the factors have actually underperformed Sensex. If you see, the white one is Sensex. So it's not, there is a key element for factor investing is its cyclicity, right? So the reason factor investing is working, the core is that it needs a long term horizon for the investor to actually have the factor work for you. And they undergo considerable periods of underperformance, and that's the reason many not it's not suitable for many institutional investors and probably retail investors with and we have anecdotal evidence that the investment horizon for many of the investors in the world are much lower, and they're not 5-6 years, they're much lower. So that's where the people are not able to arbitrage away the factor alpha. Now yeah so there are three solutions to this problem, right? Either you increase your investment horizon, right, which is, as we said, I just said, it's easier said than done. Problem, people do not have mandate and there is job risk to the fund manager. They do not have that much time to actually run the single factor strategy, right, with that considerable underperformance. The other problem is that you time the factors, right? You just move from one factor to the other when it starts performing, which I think there's been a considerable amount of academic and institutional attempt. Maybe some people, some experts may be doing it, but at least I don't know a clear way to do it. There are some papers doing trend following on factors and maybe with some success, but it's not a very clear answer. So that is also not the easiest way, where you can actually reduce the underperformance and or the cyclicity of it and while keeping your performance intact, is running multi-factor strategy. And that's what we saw in the just the session, last session. The PIM was running actually a quality low volatility and sorry, not low volatility, momentum, and a dividend yield factor investing strategies, combining all three. And why we need to, what is the benefit of combining, right? So the problem with the good thing about combining is that the factor investing, especially value, right, in India, this is basis India, has a low or negative correlation with other factors. So actually, if you combine value with other factors, there are considerable diversification benefits. So others also, there is low volatility apart from quality and low volatility. I think that's the reason why uh, you normally won't see low volatility and quality being combined, because they end up being the same stocks, right? So you can actually run momentum and low volatility because the correlation is low, right? So there are benefits of diversification. There are two ways you can do multi-factor investing. One approach is just run two different strategies and combine them and take it as a portfolio, right? Just buy 10 stocks value which are due to value factor, just buy 10 stocks which are due under momentum factor, and then just consider this as a portfolio. You will probably do well. My view, and there are other ways to combine both the factors at the time of portfolio creation itself. That's what PIM is doing, and my view is actually similar. While you run two strategies, and there are pros and cons with the strategies, but the first one, where you run fund of fund kind of, the issue is that you end up diluting factor exposure considerably, because the kind of stocks momentum will not have any value factor involved, right? So if you take pure momentum and pure value, I think you're diluting a lot of factor exposure by doing that. Now, just as an example, and this may be true for India, not very sure, because we don't have the same data, is that this is a chart by S&P where they prepared an index of indices, QVM, which is shown by the purple dot, and a pink dot is their multi-factor index, which is quality, value, and momentum, which has actually generated better risk return. Both of them are done well. Maybe quality was doing even better for than the QVM, but the multi-factor even outperformed that. So that's where we are, and that's the idea. That's my and we at CGR Wealth also run a value momentum strategy with fair bit of success. Though I think long term success is what it will probably mean for us. But yeah, the at least the maths is in our favor. Now, designing and backtesting factor investing strategies. So yeah, the first thing, the basics of it, right? So there are any investing strategies, there are 5 elements, right, which are necessary. Firstly, you have to define your universe. What are you going to actually take? Are you may define it using market cap, you may define it using exchange, I'm only going to invest in NSE listed stocks, or you may define it saying I'm going to invest only in the most liquid stocks. So liquid, there can be liquid filters. Then you define your entry criteria, which can be fundamental based. I am only going to invest in high ROE, high growth stocks, right? Or or then it can be either price based. So I'll only buy stocks which are above 200 DMA, right? So there are multiple ways you can define your entry rules, but it is necessary that you define your rules. The most important of all this, I think, even more important than entry rules, is the position size, right? Even if you select a good stock and out of your whole net worth you invest only 1%, then it's not even if it becomes 10x, it's not really moving your needle, right? It's not like a big thing. So it's important that you decide that what is the number of stocks or the position size, because that will entail uh, it's also part of risk management. So if you so there are studies saying beyond 35, number of stocks beyond 35, probably the benefit of diversification decays down considerably. So up till 35 is fine, and you have to actually pick what you are comfortable with every you can, if you have 10, I think probably more concentrated, but that it depends on your comfort. But you have to decide that what are the number of stocks you are going to hold in your portfolio. Then the fourth thing is rebalancing frequency, right? So rebalancing frequency can be quarterly, monthly, daily, weekly, and not I'm not every rebalancing you have to do trade. So idea of rebalancing frequency is when are you re-looking at your entry rules, right? And once you've entered certain stocks, when are you re-looking or rechecking them at what frequency to see if all the rules are being held. And then obviously last thing is you define your exit rules, and this is, I think, where the game is. So there are enough research. I think there's a recent research also. So most fundamental investors or the institutional ones, especially, they do very well while entry, right? So they will do, they are mostly, when they buy something, the stock is outperforms the rest of the portfolio and even the market uh, after they bought, let's say next 12 months or next 24 months. But the problem is exit, right? So most of the institutional investors, and this is also in how we are as the retail investors or the community, is the whole investing community, is that the most talked about things are only buys. What is what, क्या नया खरीदा है, क्या नया खरीदा है, Nobody comes and ask any. I've not heard anybody saying goes and asking fund manager ki kya becha tha abhi naya. Nobody does that. So there's an inordinate amount of focus on entry, right? What to buy, and nobody is focusing in what have you sold recently and why have you sold. So nobody is asking that. You can read any number of quarterly newsletters which are coming from PMS houses and fund managers and everyone. Everybody talks about these are the three stocks we have added, reasons for why we added. So for a quant investor or a math or a I would say factor investor or whatever, basically a system. If you have a system, the biggest edge comes from having a defined exit rule, right? Where you can say, okay, now my exit rule is not meeting, I'm going to exit no matter what. So that's where the biggest edge comes in. Now let's go down actually to doing this. So I've taken a very simple strategy. I will. So if somebody is using ME broker, probably they will be able to see. But so what is okay? Yeah. So so what we are doing is we are taking any listed stock. I'm keeping the rebalancing frequency daily. So I'm taking one stock. The one stock strategy, simple, just to understand how do we make a quant rule. Then we have an entry exit rule. So I'm going to buy if a slow moving average fast moving average cuts the slow moving average from below. So basically we are having a EMA crossover. So if the EMA 20 crosses EMA 50 from below, I'm going to buy, and I'm going to sell the same stock and even short it if I if the reverse happens. So if the fast moving average cuts the slow moving average from above, I'm going to sell and short the stock, and I am going to execute that trade on the next day open. So let's say this event happened today, I'm going to do the trade next day. So that's what I'm trying to define here, and I just defined a random position size with 3 lakhs, right? So let's go down. If you have ME broker, I think we can open it. Okay. So this is how ME broker would look for someone who has opened it. I'll just go into analysis formula editor. So that's what I am not. We probably not. We don't have time to actually write the code uh, with us. I will, but I have written that code already. I'll try to explain what is happening, right? So first part of the set chart options and also this end title plots. So all these parts are basically we are trying to create a chart of this, so to visualize what is happening when we are buying and when we are selling. This is not useful for backtesting. This is just to I have put in so that I can show you what is happening in the backtesting. So this is not really useful. Probably easily you can search on Google how to create a chart in ME broker and you will find it. This is not a very big deal. Now the important thing which we are looking here is how do we define backtesting rules. So first of all you have to define when to trade, right? So what will be your buy and selling event, right? When will it happen? So first thing what I'm trying to explain here, I just said I will buy when the cross of EMA close 20 happens from EMA close 50, right? So positive EMA crossover I'm going to buy, right? And I think I've discussed with Ravi, for people who are not carrying laptop and probably not been able to write this code, we will share the at least the simple ones so that you can build upon it. So we will share that with you. So don't worry about that. I think focus on the logic here. The syntax can be learnt over time. Yeah. So the firstly, I've tried to define buy and sell, when will it happen, and I'm also saying I can actually if you only want a long only strategy, the first two statements are enough. If you want a long and short strategy, and I'm doing in cash, so there are problems with it, but just for the back testing purpose we are doing, I'm also saying the short is equal to sell, which means I'm also going to short when the selling event happens. So not only I'm going to exit the long, I'm also going to sell that stock further, right? Then what I'm saying is when to execute that trade, right? So I've decided, okay, buy karna hai, but when do I buy that? So what I'm saying is I'm going to buy on the next day open. So when I say how do I define next day, there is a code called set trade delays. So once the event has happened, I am setting trade delays, and this is very important. And I think you can use any software if you're not specifying your execution day correctly. So what can happen is that the event happened today, and if I just said open, right, what could have happened is that the back testing results would give exceedingly good results, because I am buying before the event has even happened. So actually the I'm buying a stock which is going to move up, right? So back testing, this system doesn't know that what are you saying. It will give you result as per what you write. So it is not going to predict that you are buying before the buy event has happened. It will just see, okay, buy event has happened, they are saying I am going to buy at open, so the buy, this is the open price. So that's the reason why any system you use, make sure that your execution is actually what is going to happen. So for any investor who is doing this simple strategy, probably at the end of the day you will see, okay, the EMA crossover happened today in these many stocks, I am going to buy it tomorrow opening, right? And then now there are now you have to see how much position size I am going to trade, right? So what you're doing is I set position size, which is value, right? Basically I'm going to buy 3 lakh worth of stocks. There are ways you can say I can buy 1,000 shares, which is SPS shares, and then there is SPS percentage equity. So for that you have to define an initial equity. So you can say I have 20 lakhs, and out of that 20 lakhs I'm going to buy 10% equity in this stock, right? And then this is again to plot the buying and selling event so that you will be able to see it. So let's just apply this and go to here. So this is the database which the users will have. And what I will try to do is that just to create a new analysis, just select, uh, let's say I selected American Express. So the data is here is quite limited, and I will probably show you how the same thing will work in NSE. But so let's say we will take, just for simplicity, we'll take 2012 to 2015 in how did it work in American Express, right? So what is the first thing is your universe. So this is a single stock strategy. So we have already selected American Express above. So I'm selecting apply to current, right? Then next thing what I will do is that, like we said, the data available is only from 2011 sometime. So I'm just for the sake of simplicity taking from 2012 to 2015 somewhere, right? And just selecting the EMA crossover. So from these two dates we are going to select. Then you have to see initial equity you have to put in here, because we didn't define that in the main code. So either we can define it here or put here. You have to select long and short. So there are options to long, short. But having said that, if your code will take precedence over this. So if you have said initial equity 20 lakhs there, even if you put 10 lakhs, that won't work. So 20, it will take 20 lakhs. So that the code will take precedence over this. Then what? So here we have put Reliance. Let me just replace it with Boeing. So what pattern align does is that if let's say a illiquid stocks comes in and it's not being traded for a while. So what pattern align does is we will take the most liquid, let's say Reliance for that example, and illiquid stock. So for days where that stock is not traded, it will carry forward the uh, price. Otherwise, what will happen is it will show zero, and suddenly the whole system will go for a toss. So it is necessary that you put pattern align, which is a which has been traded during that period. That obviously, so you cannot, if you take TCS, then you will have a problem that it got listed somewhere later. So you won't be able to use it for those years before it was listed. So that is the problem. Now we have to put in minimum shares and minimum lot so that we don't buy fractional shares. So if it's USA, probably even we can actually put zero also, then let the fractional shares comes in. But just for the sake of it, it's we are in India, so we don't allow fractional shares. So it's better to define it as one minimum shares, and minimum round lot size is also one. Then one important thing which gets missed out in backtesting is the transaction cost. So it's good to actually get an estimate in your mind that if you are buying and selling, how much is your brokerage plus STT plus everything is going to be there, and you build that in. I've just taken, for simplicity, taken a percentage and 0.01% of the trade here. That's about it. There are other things which have been disabled. You can actually set up stops also. You can say, okay, if the trade has 10, it's 10% loss, that will exit will happen. So all those things can be done. Now just focus on backtesting. So I just hit the backtesting button. This is how the backtesting results are. The main, obviously, what we are looking at is the cumulative profit. So actually, this strategy is not working on, at least on the American Express, right? You are actually losing money. You made money, and the simple reason could be either this, there must be there, it is not in a straight trend, right? So if American Express is moving like this, then you are actually getting whipsawed, because we are taking very short tenor to moving averages and trying to time the market, and the market is actually being, you are being whipsawed. If you really, probably, if you we will take long tenor moving averages, maybe the situation will change, right? And just to show you how much, what all we get is that you obviously you are making losses. You did 26 trades in total, only 5 are winners. So this win loser ratio is one thing which you need to be very careful, because if it is very skewed, I think the strategy may have made one trade which is very great. If let's say we end up with profit and this is very skewed, then also that strategy is not very good. Because it's very difficult to run that strategy, and by the time you get reach that winning trade, you would have lost faith in that strategy. So it's good to have a balanced, at least if you have winners, more winners than losers, then nothing like it, but at least have some balance. One thing which is very important is what is the maximum system drawdown. In If we would have utilized the full initial capital, then probably we would have looked at percentage. But let's, on a 3 lakh capital, effectively we are actually losing in this strategy 1.5 lakh. So effect one more than 1.5, so effectively a 60% drawdown, right? Which is not sustainable. No retail investors at least can run this strategy, or institution, for definitely the manager will get fired. So for sure, this will happen. Where the act So this is how it will look. So basically, you started with 10 million, you made some amount of money, then lost it, then you gained some amount of money, then again kept on losing it, because the market would have exited trending market. And so this is how it calculates. So from maximum drawdown is nothing from your peak net worth to your trough, right? So peak value of your portfolio to the trough, so last whatever, so that is your maximum drawdown. So that will what will impact you considerably. This is how the profit table looks like. So you made money initially for 4 months, then lost it all during the year, and ended up at a loss. Then again in 2013, we made money, we made some money. Then we will see it, this would must be a market where there was a long term trend, right? Because that's what we would have captured. 2014 again we lost, again choppy market. 2015 again we are losing money. So let's just see what I'm saying. Okay, why am I looking at it? Yeah, so let's just go here. So if you can see, right? So we started somewhere in 2012 here, right? So first few trades, if you would have seen, we made the money where there was trend. The first trade itself we made money. We entered somewhere here, the trend continued for 4, 5, 6 months, and then we are exiting here, so we are able to capture this. But post that, if you see in 2012, the market is quite choppy, right? So we kept on losing, and you will see that you kept on losing money because of this strategy. And if you see, these red markers are where we are selling and green is where we are buying, just to showcase. So you would see there are so many trades. You are selling here, buying again here, then again selling, then buying here, then again selling. So you're actually losing money. uh, Again, like I said, the next year we made money because of this big trend, right? So if we are able to enter here and exit here, right? So if you get a stock which is in a long term trend, then probably this strategy might work. But again, not for every stock, right? So here again you would have lost money, then again we made some money, lost some. So that's how this strategy will work. Now this is about single factor strategy.
Sorry, you put a stop loss condition?
No, I have not.
And even then we lost, right?
Yeah. So if I put stop loss, let's say here, if I say okay, some percentage, not profit target, trailing, yeah, let's say I say 5%, then probably will have some exits. I'm not very sure. Yeah, so you can see there are some exits happening because the maximum loss got hit, right? So you can play around with this. So that's not a you have various ways to do it, but normally the such I would say hard coded stops don't work. Normally trailing stop is what normally works, and if you are able to like if you say 5% loss I will sell, normally those things won't work on a long term data. That's how normally this works. Now let's just see. Now let me again go back to some bit of what is important in backtesting. So one is obviously, like I think the speaker in one session also said, the main issue is data quality, right? And there are data vendors in India for ME broker, and anyways, I think for across the problem, there is the big problem of data quality. You have to ensure that there is no survivorship bias in the data, or it is adjusted for corporate actions. Also, one thing which is important is, if you are running an investing strategy, then you need to have a minimum period of data, right? You cannot rely on 5-year data. If you are running a monthly rebalancing strategy, you are not even capturing a cycle. So specifically in India, the data quality improved post 2005, for especially for NSE. You do not have quality data before that, though it started long back, but the data quality improved post 2005. Return parameters, obviously, if you are an investor, the focus should be long term returns. No question about it. You cannot say, I this strategy is giving 3-year returns, I'm going to invest in it, because post 3 years it may not underperform. You have to also check what are the drivers of return. So why I am saying that is, if you are running a portfolio and only one stock out of that portfolio did 1000% and rest of them are not doing so well, so there is a chance that while running it live you may miss that stock, right? So until unless there is certain distribution, at least you should have. So there will be Pareto principle applied. So your 20 out of 100, 20 will give you return. So that is going to be there. But the problem is, it should not be too concentrated, right? It should not be one stock giving the complete return or driving all the return, and the rest of them are losing, right? So that is very important while you are back testing. One thing you have to check is returns over time, right? So like we did from 3-year period, if we would have had a lot of data, we would have checked, is this strategy working for ruling 3-year periods, right? So from 2000 January 2005 to 2008, 8 to 12, we would have broken that up and checked if all the 3-year periods if this strategy is working or not. Obviously, the biggest focus in backtesting is wall risk ratios. Apart from returns, is that you need to be very, very, like I said, I personally focus on maximum drawdown. So there can be multiple such strategies you can design which can give you 30-40%, but the problem with them is that you will have 40-50% of drawdown in normal cases, and that is, those strategies just look good on paper. So if you have a 40% draw, 40-50% of drawdown, just imagine you invested 1 CR, you tripled that to 3 crore, and that had a 50% drawdown, so you're back to 1.5. This is not going to be easy for any investor to, especially that strategy might do well after that, but you will probably exit that strategy, and that's where the whole point is, that you design strategies with where limited maximum drawdown is there, and you can probably wish that that will happen in live also, but at least have that strategy designed that maximum drawdowns are limited, and we will see how we can do that. There are, make sure that you include transaction cost while you're doing back testing, because some of the strategies, the biggest edge comes from not having transaction cost and having so much churn. Suddenly if you build transaction cost, the whole alpha goes off. Then there is, obviously, so if I will reduce the maximum drawdown, I'm quite assured that return will also have a certain bit of beating, right? So if you in so I'm saying not every strategy, but most of the strategy, this balance would be there, right? What is the, how much maximum drawdown are you comfortable with? If you are comfortable with zero maximum drawdown, then obviously there will be no returns. So if you are comfortable with 10, so commensurately you will get some return. So effectively, that is what the choice is with the investor while designing the strategy. What is the balance between risk protection and return generation? Then the fifth one is optimization, and which is not, I'm not so much of a fan. This, the issue here is that we have a set of data which is, we do not have an alternative history, right? We have one set of history available with us. This is how the world has done, or the NSE stock, listed stock space has done. We do not have alternative says that if this would have happened, this could have been the case. So what if you optimize too much on too many parameters in a strategy? Then the issue with what happens is it's just curve fitting your strategy to that data. And obviously, if you have the ways to do it, you should have a simulation, Monte Carlo simulation. I think ME Broker also has. Probably once you go back, you can actually run it and see what it means. The help in ME Broker, even in the same ME Broker tool itself, is very, very easy read. So it's not such a problem. I think Ravi was asking me before the session that if I can name the data vendors. So I think there are, if you want just do the back testing and not actually trade, then I think there are EOD data vendors, which are Vera Tech is there. Then there is Trend Watch India is there. There is Finosis. Then there is a way to actually download the data free also from NSE, which is Get Bhav Copy, and update. You will find, if you just search how to upload NSE data in ME Broker in YouTube, and you will get a video how to do download and upload it. It's slight bit of manual work. That's why I didn't suggest it to do it before the workshop, because uh, even then would have taken so much time. I use a vendor called StockSense. Then there are real-time data providers, which are I think, which are globally available, which are global data feeds is there. Reuters, I think the most quality available is Reuters, uh, but it's expensive, decently expensive, until unless you are doing intraday trading, or actually going to uh, uh, use that data to actually trade, in the sense that the system itself is going to trade. Then the Reuters is a good data provider. Otherwise, if data provider is not needed, uh, the the EOD data providers are good enough. So let's just no. So problem is, see, trading view, we have facility on single stocks. right? I have not seen a trade in trading view. I have not been able to find a way to run the strategy on a portfolio of stocks, right? So that is the issue. So trading view single strategy, I think PineScript does very well, and you can probably use it, no problem. It is considerably good. I think better, easy, even easier than this on a single stock. So that's the reason. So if you search, you will find most of the things people are coding on trading view, but that is the issue. There is you cannot run it on a portfolio. No, so let's just first see how manage gap up and gap down. Uh, yeah. No, so I'm anyways running an investing strategy. I'm only going to check at the rebalancing time, right? So even if gap up happens. I'm okay to withstand that. So that's why I'm not such a fan of keeping stop loss, because stop loss here may give certain result in gap. If it is gapping down and gap up, may not look like a real return. So yeah, let's just go back to what we were actually looking to do. Is that let's take a simple momentum strategy, right? So is anybody coding this strategy with me, or nobody is doing it? Then we will just use NSE data. Nobody is doing it, right? So let's just skip this, right? So yeah, so this is the on NSE universe. I am defining a simple momentum strategy, right? Which is I am saying NSE listed stocks volume. I've just put some volume filter so that I'm avoiding illiquid stocks, right? That is the main focus area for me. I'm avoiding price which is less than 30. So penny stocks go out of the picture. I don't want those stocks to be there in my portfolio. Just my You can have them, but I don't like penny stocks because they're too volatile. Rebalancing frequency monthly, you can have weekly, multiple ways are there. So these are the levers, right? You can define your universe, that will impact your returns. You define your rebalancing frequency, that will impact your returns. You have your entry and exit rule, that definitely will impact your returns. So what I am defining as my entry rule is that I am going to buy the top 25 stocks with the highest 12-month returns, right? That is as simple as it gets. The academic literature is 12 minus 1, but that you can take the 11 month return, but that's fine. I'm just taking 12-month return, including the last 1 month return. The reason for academic literature is the last 1 month is mean reversion and all that, but it works fine. It doesn't matter. If you want you can take 12 minus 1 also, but it doesn't change so much, it doesn't move the needle. What I'm saying is I will hold the stock till the time it ranks 75, right? So I've taken entry and exit rules are slightly different. I'm only buying a stock which is in the top 25, but once it gets in the portfolio, I'm giving it a slight leeway and holding it till the rank is 75. So it's not so kind of trying to reduce churn and not just running around uh, churning the stocks. I think price I've already said. Position size I already said 25 stocks we are going to buy, and I'm taking it very simple. I'm just going to start with equal weighted, and once I've started with equal weighted, then the weights will not be rebalanced to equal. Then I will let my winners run. So any good strategy for that matter, at least that's my view, is that you do not cut your winners easily, right? You give them slight more leeway, right? You if something has a good characteristics, I think you cut your, and you have become, you be ruthless with cutting down your losers, right? So I think you will see, once you become ruthless with cutting down your losers and letting your winners win, I think the half the battle is already done. So that's what we are doing. We are not rebalancing them to equal, to actually trim down the weights to weights lower. If something is performing, I'm letting it run. Now let's just see. Okay, this is probably I will come later, right? So let's just see how this, how will I design this strategy. This is database. Okay, yeah. So NSE 12 months, right? So firstly, this is something which is slightly unique to ME Broker, or maybe there are other softwares. I don't know. I'm sure Bloomberg might be able to do it. But what you can do is you can enable rotational trading, right? And there are so the same thing otherwise would have gone to I am easily 100 lines, and when you run a loop, right? So that is the issue. The easier what it makes is easy is that you just say enable rotational trading and the system will run a loop for you, right? So that is what the easy. You can actually in ME Broker itself, if you don't want to use enable rotational trading and take more control over your program, you can actually write the whole thing in a loop as a loop. But that is that there are some advantage to it, but this is good enough for to start with, right? You enable rotational trading. Then, as I said, I defined my initial equity to 10 lakhs. Then I said trade delays. I'm only designing a long only strategy. So I'm just defining buy price and sell price, not worrying about shorting and covering that maximum positions where we've already said 25. And then you said, then I defined my position size as 100 upon maximum position, so 4% of the portfolio goes into every stock. This is how it has been defined. Then what I'm saying is that I'm defining minimum shares here itself, saying I'm only going to buy one stock as minimum shares. There are no fractional shares involved. Max open positions, this may not be needed, but just be there. Set options, here there is a function called worst rank held, where I'm defining that I'm going to hold till 75, right? So that's what I'm doing. Then at the start, yeah. And then once they run, they can become bigger, right? So starting, we are starting with 4% in all the stock. And when other new one enters, they also enter at 4% of the equity, right? So yeah, so then what we are defining as the rate of change or percentage return annually, I've taken close of last 252 days. Similarly, 1 year rank, I'm saying, then I ranked those 252 days, right? So here, if the issue, if without enable rotational trading, is this is not going to capture all the data. They will capture the last run data, right? When why we are running it as a rotation is basically, this definition is for all the stocks, right? So if it doesn't rotate, or if it's not going to run that loop, you will not have, you will have just the data of the last stock which it ran, so it will not be able to capture it correctly. Now, volume, there is a volume filter I have put in, as I said. So I took 1 week average. So when you say reference, there is a function I've used, which is basically, if I in volume, if I want to see something previous, right? So if I put volume minus 21, so I can actually select volume of 21 days back. And similarly, you can use it. And a lot of like you see, I am using close -1 as my and so what I'm trying to do is, I'm not the bar where the action is happening. I'm trying to use the filters of the day before, because that is what will happen to us, right? So normally all the filters will have, we will see the data of day before, which is closed, right? So once we are on the day today, we would see, we will only buy those stocks which are penny, not penny. So I'm going to compare this with last day ending, right? That's what is happening here. This is just to avoid stocks which have actually delisted, right? So I'm just, it's a brute tool. There are good ways to do it. I have just taken a simple way out, that if the rate of change in 7 days has not happened, then just don't consider that stock, right? I think there are much more sophisticated ways to do it. This is a much easier and easier to understand tool. I've taken 7 days because there's a simple reason, because it may happen that for a day that trade didn't get traded. So I just taken 7 days, right? And then, so what here, if you see, it's a simple if rule like we do in Excel, and then adding rules. So I'm not buying penny stocks, not obviously unlisted stocks we can't buy. Volume 1 week average, I am saying, should be more than 50 lakhs. Then the ranking criteria, once these conditions are met, then the ranking criteria is there. Otherwise, the ranking goes to 0. So if a stock is penny, its ranking is 0. Position ranking criteria becomes 0. Then we have a this is position score is a function in ME broker which is basically says that you are able to say that you buy the top 25, right? So it will buy those stocks which have the highest position score. That's how you define. So that's why what I'm trying to do, what I'm saying is only when month changes, right? This is what I've defined. Only when month changes, you just bring the ranking criteria in. Otherwise, do not rotate, right? So what I'm doing is on the first day of the month, I'm going to rebalance. Otherwise, during the month, whatever happens, let it run. Do not touch it, right? And that's about it. There are obviously you will say that if I want to do it weekly, so there are few ways to do it. Like I said here, you can say define day of week 5, and on Friday I am going to rebalance every time, and that would be easily done. Now let's just go to yes.
275 meant that even in the next month, if it goes below 76, it will be rebalanced. In that particular stock, you said that if anything above 75,
Right.
beyond 75, it will go out of the.
Right. Yeah, so it will we will sell that stock and buy something which is in the top 25, right? Now let's just change the database, right? And this, let's go to ns, sorry, right? And here, so why I'm selecting filter is, the issue is the NSE database also has indices, so I'm actually excluding the indices, right? I've just created a watch list of indices and excluded that. So just showing. Otherwise, like, we could have done all symbols, but the issue is we don't want indices to be part of our universe. We are just looking at stocks at the moment, so we are excluding indices from the universe. That's just something which is unique to my database. It may not happen to others who are just uploading equity stocks and not uploading indices. So then it will not happen. But just something I just wanted to tell. Then you can do, if you want to just select a universe of uh, whatever if you want, you can have a 20-30 stock which you have identified and want to see that on these 30 stocks does momentum work. Then that also can be done. So you can actually create a watch list and select that watch list as your universe and do the strategy. So what I'm doing is all NSE listed stocks. Then obviously here we have ample data. So let's just run from January 2005 till September 30th, right? So that's where we are. Again, let's just check analysis here. Obviously, this we need to change. Like I said, right? Again, just changing it to long. This is okay. Monthly, it will only happen monthly, or rest of this is okay. Stops I will probably disable, right? So yeah, that's about it. Oh, this is not the analysis, is it? Yeah, this is not. So okay, so let's just hit backtest. It might take few seconds. Yeah. So anybody has any questions till now, till the time the backtest runs? No. Very good. Let's just see how the backtest looks like. right? So you can see there is a long list of trades happening, and you have at the end of September we have these open companies, and you will probably, if you have been tracking markets, most of these companies you can see they've been doing well in the recent times. And obviously doing well, especially Cupid. I already said change of management has happened. Kaplan Point has done well, great result. BSC, surprisingly, some of the large caps, Bhel is there, which is also in momentum. So how we have defined momentum? So there are ways to define momentum. You can probably combine the look. So what you call this 12 month is a look back period. So I can actually change the look back period to 6 month, 3 month, have different combine different look back periods, play around with it. ROC is just a way to say momentum. Probably you can use, if you want to use technical factors, you can say I'm going to use RSI or moving averages to select all your distance from, or the one of the fact things which have been being run for a long many players is all time high strategies, which basically you buy only stocks which have either very close to or touched all time high. So that is also one kind of momentum strategy. Just buy something, and there are enough studies that if you buy something on either 52-week high or all time high, they continue to do well. And that's a very good example, simple example of why there are stocks which momentum works. So yeah, so let's just see how this strategy actually did, right? So that's where we are. uh, Very good analytically. So what we started with 20 lakhs in 2005. So that's slightly considerably long tenor. So 2005 to 2023. So don't look at the numbers. So basically, we started 20 lakh. We would have ended at 4.6 crores. The returns, annualized returns are, so the annual returns are 18.5%. Very good, decent. But the again here also, if you see, like I said, even if this is with, if there is some amount of balance between winners and losers, I think you will generate good returns if the strategy is decently designed. So, and it's a very simple example, momentum is working. The issue which comes in is this maximum drawdown, right? So, and this is the Achilles heel of all strategies in India, and this is specifically due to the 2008 crash, right? Any strategy you built in, it's very difficult to actually, and long only specifically. So there's obviously, that's the reason why a lot of people become interested in these like hedging strategies and long short, is such 2-3 sigma crashes where which black swan events for that example. So which is where all those strategies comes in. Even so, if you imagine, we actually fall by 64%, and then again we have built up the portfolio to this much. So which is where why this is a strategy which has been become so popular. So if you see, the chart is upward trending, which is a good thing. uh, the problem is here, right? It might look smaller, but at that time you started with 10 lakhs, growed it, and then the fall happened sharply, and this is the reason. So you see the sharp fall, right? 64%, and which where you probably will become difficult for you to continue doing this strategy. I think not probable, definitely it will become impossible. And but I think, but at that time the market itself fell by 50-55%. Sorry. Yeah, so I'm saying but even, so I'm saying for anybody 60%, even if benchmark falls 80%, you fall by 60%, 60% you are anyways going to exit, or not going to able to sustain that, right? So and this is actually the period, at least I know a lot of senior investors who move to absolute return strategies, right? And this is a reason where they actually the portfolio got cut in half. They were doing it full time. People had to actually either go back to jobs and stuff like that. So this is the kind of thing which can happen to for a full time investor, right? So if 60% is not child's play, right? If 60% falls, then your net worth is actually falling by 60% for a full time investor to a large extent. Uh,
Within the first 3 months, I've stopped you from trading.
Sorry.
Assuming that strategy was there,
Right. So
within the first three
yeah,
months, you have stopped you, right?
yeah. So that's what you can change and build upon this. But the issue with any filter or way to do it is that the and which we will see in 2020 why we are ending up in positive is that if you put a filter you might reduce the drawdown when the fall is continuous, but when the fall is v-shaped those filters will actually bring down your return. So that's why I'm saying there's a fine balance. You can probably the better way to do it is that you buy some hedge outside, right? So otherwise, because otherwise if you want to curb this thing or this sigma event, then I think a lot of the where the strategy is working will not work. So
And then you just showed the 2020, if you see March
yeah, so in April, so the otherwise if you would exit here, maybe let's say you will not get some, so you will get the indication here only in March, then you will probably be able to get back to trading somewhere in May or something, right? Then you would probably make money, but a large sudden gain in 2020 came from that, and we will see. I'll show you a market regime filter on top of this strategy how that works, and that also works well. So it's not like a big problem. So this is a very good way to look at your strategy to identify what you could do, right? So like sir said, in 2008 this is the problem area, right? Continuous fall. So if you can build upon this a filter which says if it's falling continuously go do something about it, then I think you can probably save same. Otherwise normally such a large fall doesn't happen. Maybe 2011 something is happening, but it recovered after that, and stuff like that. But overall this strategy has done well if just for from backtesting purpose. But the issue or the why it is not investable is this. But like I think he was saying, the benchmark itself is falling so much. But see there where comes the difference between probably where you are coming from. So if you have come from a investing thought process, probably for investors 20-30% drawdowns are par for course, right? Of if per But I know for a fact that people who are doing full time as traders, 20-30% would be like a shock to their whole strategy, right? They are used to 2-3% fall. So that's where you have to be sure that you design your strategy as per you and not for just for higher return, because you might not be able to sustain that, right? So that's where we are. Yeah, okay. So now like I said, how do we so yeah, we have seen these results. One thing which we should definitely do is that you run the strategies for different periods. So what could happen is that you got in a stock and it kept on running. It fell for a while, right? And if and that stock was within 75, but it got out of the top 25. So if so it what may have happened that my starting point was correct, right? So the starting point also matters, because the starting stocks, if one of that stock goes on to become, I had some volatility in between and I was able to sustain it due to my exit filter being slightly lax, that may impact my portfolio if I start it today. So you have to do it for certain periods. It just take 5-10 years of different periods and try and do that. I ran that. It worked well from April 2018 till September 2023. For last 5 years, momentum has been doing well. So it's not like anything.
The previous backtest 2005, 2023, Nifty listed universe. The system will make Nifty listed universe as from 2005
Right, right, right. So we do not have, so that where data comes in. The system will take whatever stocks are there. So if your data is as per the today listed stocks, then the survivorship bias has come in. What you should have data which you should have all the data. So all the stocks which listed got delisted. So all the data should be there in your data set. Then that's for the reason I did that brute kind of thing, that if it doesn't change for 7 days, I'm exiting, because I have unlisted stocks also which got delisted. Sorry, not unlisted, not delisted stocks also. So that way that this data is okay. This data is also average. I think the pure quality data are the ones which are doing it. They are expensive, or definitely expensive. So yeah. No, not me. So I have taken a data vendor. I'm saying that is also an option, downloading Bhav copy and doing it. But Bhav copy also you have to slightly be careful. So that's the reason. That's what I'm saying. I have. That's for the reason I went to a vendor. I did that earlier and did work. But so at least these simple things they have taken care of. But yeah, I'm sure there must be some gaps in that vendor, because the real quality is probably slightly more expensive. But yeah, see, I rely on backtesting to only to a certain extent, right? To just to get your hypothesis. So I am not very big fan of doing it the other way around, right? The principal component analysis, right? That just take the data and then try to find something which is working. Then I think you should have. That's the reason I initially covered what are we doing and what are factors. Is that you should, what are you trying to do? If you have that idea, then probably you can tweak a bit, like reducing drawdowns. But I'm running a momentum factor. At least you should know that. Not like what on this data set what has worked. So that will not probably help. I'm sure people must be doing it, but at least what I believe is that you don't do it the other way around. First, write your hypothesis, then test it. Do not start testing and then try to find the hypothesis from it, or design a strategy from the data. Yeah, so that's about it. Just I think one few last bits. Like I said, let's do a market regime filter, right? So very simple 3-line code. I just called in the nifty 50 as index in my whole same strategy, and said and defined a parameter which said bear market is there if it falls by 15% in a month, right? Just you can say 5%, 10%, whatever. I'm just said one criteria. I said 15% fall, I will define it as a bear market. Now this will say bear, this will become 1 if there is bear market, otherwise it will remain 0. So that is what is happening here. Then I said restore price array. So that it has been we have kept that bear market, forgot about nifty 50, wrote the code, rest of the code is same. Then at the time of position score, I said if bear market is there, just exit all, right? So till the time bear market is there, it will not take any position. One other way to do it is that you define your position size in if, and say if bear market is there, reduce my position size to 0. So at least when you sell, you won't buy. But that doesn't help so much, because it's not really going fully cash, only the stocks, because even most of the time something is there in bull market, right? Some one or two stocks would be top rank. So either you put in a absolute momentum filter here, saying I only buy if 12-month return is above 15%. So then I think you can play around, do whatever you want to. You can do that. You can even uh, right. So this is a change which we are doing. I just said exit all. Now let's just see how
So what
how.
happens if it's exit or you stop the strategy and start later? Is it again?
So yeah, it exited everything, and we didn't wait for month end. What we did is the time it hit 15%, I just exited. Went to cash, waited for next month to check. Then it will keep on checking.
You start with a fresh 25 or
Yeah. Yeah. So that's the idea with cash, right? If the strategy goes into cash, you are starting a new thing. So that's how it will be for any strategy, right? And now let's just select that strategy. Okay, yeah, here, and just hit back test. Right now, let's just see if it improved something. Some returns has also improved slight bit, and the drawdown has also improved. So from 66 to 52%.
much higher now. It was 4 crores.
Yeah, but in 1% only, 18 to 19. But the tenor is so long, so like you said, compounding in play. So that's the simple reason. Now, if you see the chart, I think it will show here. If you see these here, if you see, it has become flat. Here also, it became flat for a while, and we will get the sense here probably. So after 2008, here it went to cash, right? Again 2020 it would have gone to cash. So April it is, so basically in March it started going in cash. In April it was not able to, the it was still in bear market. The Nifty was down 15%. Once at the start of May it said Nifty is not falling 10-15% in the last 1 month. Let's just start the thing again. So it is again started. So that is a simple way to look at it. We probably were able to reduce the drawdown in that year. Here, I don't know, 2020, I think it was 23-22%, which also came down a bit. So yeah, it's a give or take kind of thing. In So this has probably protected 10%. If you want to make it the market regime more stringent, then these kind of flat lines will appear more often, and returns will also reduce. So let's just see what actually, where do we actually went to cash, right? 2008. Uh, so yeah, 24th January it suddenly went to cash, right? All exit dates are 24th January. It was not even month. We suddenly at that date we are exiting. Then we got back on March starting. February we were not able to do trade. Similarly, in 2020, somewhere 16th or 17th March, it would have gone. Uh, yeah, 16th March. So yeah, that's what I brought in that, right. You can probably do it monthly, but what I said is that if I will watch the Nifty 50, and if it flags a bear market, I'm going to exit fully. So that is happening every time. So that's what. So what I'm saying is, this is, I have defined a bear market scenario. Then I, in position score, before I decided to do month rebalancing thing, I said before that I'm going to take that call. So if I did this after that, then probably it will check only at month. So you can play around with that. So that's where we are here now. Obviously, I think so. Market regime did work better. Okay, this is done. Now there are other things you can do around with even in this same strategy. I think you can play around. You can say, I'm going to use different indicators to do it. I'm going to do weekly rebalancing. So one answer to probably reducing drawdown is that you bring down your rebalancing frequency, right? So that you are exiting the ones which have fallen sharply or something like that. But there are pros and cons to it. It brings up, it increases your cost also. Churn is more. It gives you, I think it gives you mental comfort than actual probable gains. I see a lot of players going in cash quickly and then again reinvesting. I think but that's just for investors sorry. Yeah. So and also it just for if you are managing money for people, um, if let's say in the recent fall, many people come to you and say, "The cash may why do we don't not go into cash?" So the people are just so they become more comfortable. Many money managers, specifically if you are running money, they try to take more cash calls because the investors like it. And though the data is there is enough data, I think the market has a positive bias of up move. So going into cash more frequently definitely hits you. It's not a very good strategy. Probably in Japan it may work, but not in India. Yes, position size. Like I said, you can put that filter on position size and bring it to zero if you go into risk regime, or have a stringent and reduce your position size to 2% instead of 4%, so you're actually only buying half of your thing. Optimize parameters, not so keen doing that. This is a good facility here to run Monte Carlo simulation, see at what different scenarios if the market would have uh, uh, you're not curve fitting. This is the best, not the best return out the lot. This may have worked in different scenarios. uh, there are, yeah, I think, yeah. So there are tools available. I think somebody said trading view. As I said, it doesn't work on portfolio. Trendline is one which you can run back testing on fundamental factors. Even ME broker allows that, but for that you need to have a data vendor which also has fundamental factors attached to that stock, right? So that depends on. So if you have Reuters, then you can definitely do it here also, but not in my, at least not my data set is not there. Uh, Zerodha has recently started one back testing. I don't remember the name. They've done some, I think, basic back testing models. There Bloomberg has a good back test. I think they showed the risk arbitrage also, but there is also a back testing module in Bloomberg. At least I have used initially in my corporate days. Coding, I think that is definitely being done by a lot of people, right? Yeah, so that's the issue with backtesting fundamentals. So you cannot say I will, because the quarterly data comes in next and then beyond quarter. So if you are, so that's the thing, you need to be careful while doing fundamental, that lag of data, because the data will say September 2023 this was the data, and I basis that I've decided to quit, but the market actually fell because in October, because the data came in later or whatever be the reason. So that bit of quality you have to check, that I'm not doing that, or take, maybe just take the results with a pinch of salt. The issue with trend line is that it equal weights every time, which is again not so great. It runs a portfolio, it does back testing, but every rebalancing it just goes back to equal weight, which is not so much helpful, not really you would like to do in your running portfolio. But yeah, definitely the most versatile is if you can code and code on Python. That is, but MB Broker is good enough. I think at least I have realized there's ample ways you can handle MB Broker. If just depends on your data. MB Broker, at least as a tool, it is fully equipped. If you have data as per your requirement, go, we can do it. uh, One thing which I wanted to cover, I don't know if you have time. I think we've overshot, right? Yeah. So just a very simple thing I wanted to cover, that as an individual investor, this is not so much for institutional. I think there are better ways to do it. How do you, once you've decided that I'm going to run a strategy, how do I do it, right? So let's say just a simple way to do it is just take your screener, which is good enough. I think recently call, at least for, at least as an individual investor, I think it's a beautiful tool. Then you use Google Finance and you prepare a tracking sheet. Make sure that you record all your trades so that you have historical data, record your historical NAV, some bit of work. If just be, if you want to keep record of monthly NAV or weekly, just go and do it. I'll show how you can do, and then you can track your outperformance. So what it will do is that you can actually see, are you uh, when you fall, how much you have fallen, what was your maximum drawdown and stuff like that. So this is walking forward. So this is not really back testing. I'm just giving, that's why I said just wanted to say what can be done easily. And obviously the best way to do it is you just invest some 2-3 lakhs and just run it, let's see. Otherwise maybe you lose focus. But at least I believe a lot of it can be done. So let's say this strategy, simple strategy, right? I ran a query which said market capitalization greater than zero, current price, volume 1 week average. So simple filters. This is has NSE and BSE listed both, so that I am not excluded, and for investor that doesn't matter actually. Wherever it is listed, then you can just oh yeah, I'm just doing it. We just have to take the top 25, right? I have paid the subscription so I can export it, but even then the 25 is not a big deal. You can just copy from here and put it. The thing next to do is I just create a simple Google sheet, right? So what I have done is I've taken that, let's say, let me just export. I think I've already done that. So yeah, so I exported this, and what I did is Google Sheet recognizes stocks like this. So if BSE is there, you put a bomb and plus hyphen NSE hyphen, yeah. So this is how you define it. The only thing is, what Google Sheet doesn't recognize is NSE SME listed stocks, and which is a good thing. I also don't want to run a strategy with SME listed stock, SME exchange. So if you see, if we just paste those here, uh, specifically, let me, I think I've already corrected that, right? It will not come in. So these are the ones which have NSE listed, SME listed stock. So network people, just let's just open it. So this is the, here if you see, this is a SME exchange listed stock, which we, anyways, we are not.
That's also because the market capitalization is selected
Yeah.
the market cap is greater than zero.
No. So that too already came here, right? So I didn't understand. So if you can actually say I have market capitalization more than 300 crores, and so that is defining your universe. I just wanted to replicate what we were doing, and that here at least I don't want run my on an SME listed with their own set of boundaries. So here we have placed that. Then I said start with 10 lakhs, define my buying price as LTP. So whatever was the buying price, I just copy pasted here. Then I just said 4% in each of the stocks. Then you are what you, then these are all formulas. So so this is the beauty of Google Finance, that you can bring in yesterday's close and today's close, and then you can say what is your absolute returns as per buying price and daily returns. Once you have done that, the important thing is I am going to track it again indices, right? So you can actually track how are you outperforming or underperforming indices, right? So you can actually put in different portfolios, and say this was the portfolio. Let's say I just copy this, and so let's say we are starting today, and I said okay, this is my okay, this is my starting point from today onwards. Now whatever the value changes, that will be my gains. And so this is about portfolio. Now when the transaction happens, you have to record all the transactions and adjust that in changes here. So if you have, reduce, if you are exiting something which has lost value, the buying should also happen at that amount only. So that is the kind of things you have to keep in mind. Historical NAV is one thing we keep track of. I'll show you the full sheet of one strategy so that you know how it looks like, and that's about it. So this is one. Okay. So this is one strategy which we run on momentum. So basically, you can see how this strategy we've been running. This is where the whole returns picture comes in. How much is outperformance? When and where the outperformance came in. That's why I'm saying you important to note NAV. Otherwise, it would have looked like we would have made this is a very good strategy and a very excellent strategy. But it's important people realize that yeah, we had a drawdown for a while and important, and then we outperformed again, and then also we recorded all the transaction, so which will probably help me recognize that if in the past if I entered this stock, why did I exit, or what it does is that outside your 25 stocks there must be stocks who are giving much better return. So what it makes you think is that why did my strategy miss that. So is there a need for me to change? Not every, obviously you won't be able to capture all of them, but are you missing a large part of the universe because of how you have defined the universe? Then maybe the need for changing the universe is there. So this is a very simple and elegant way to run the strategy, and I'm sure this is not for institutional investors. This is more retail oriented. So that's how you do it. Like we said, there are a lot of factor investing being done on small case. A lot of players are there. You can just go there, discover uh, here if you okay, yeah, all small cases. Just select factor investing, then probably yeah, you will, and this is as per popularity. You can actually even do 1 year return. Oh, okay, so the ours is sorry. So yeah, so probably 1 year return is too small. So that's why I'm not willing to talk about that. So yeah, so basically you see a lot of strategies as per 1 year return, but that shouldn't be done. But there are 3 year returns. We have not been there for 3 years, but yeah, many strategies have done well. So the only point I'm trying to say, the managers doing it. It's new to India. That is for sure. Maybe institutions must be doing it for a while, but at least yeah, it's not so common. I think the India, especially the world, is I think is still recognizing it more focused, or if they've been using it, they are doing it in closet. Mostly all of them talk about quality and fundamental. So now yeah. So that I actually showed the performance using those indices only, how India factors are doing. But the challenge with those indices, they have 6 month or I think yeah, if not wrong, quarterly or 6 monthly rebalancing, and individual investors can do better by reducing that frequency, especially for momentum, which is a high turnover strategy. So yeah, so that's about it from my side. If anything, I'd be happy to take the. I think I've overshot quite considerably.
Kshitiz agreed to fly down from Mumbai. Of course, it's a weekend. He does a lot of work at the society, and he was kind enough to agree to do this for us. So thanks a lot, Kshitiz. And I think what we planned, we were able to achieve. We were very keen that we have an international speaker talk about quant and factor investing and give people a nice overview. But a lot of time, we are just able to hear, people talk. We're not able to get our hands dirty. So we're really glad that we could have Kshitiz do the workshop immediately after PIM's session, and a lot of stuff, where we saw live, models. So thank you very much. Kshitiz, a small memento from all of us at the society.